Good afternoon. Welcome to Knowledge Box Sessions, Intro to Investing. Today, we have a special guest here with us today, Nathaly Minda. Also, we have Nate Howlett, one of our financial Knowledge Box speakers, talking on investing in human capital. So we should have a great session this afternoon. Thank you once again for joining us. And I'm going to go ahead and pass it to Nate.
Thanks a lot, Danny. Appreciate that. Let's hop on here. Okay, and let's do a little presentation. Where is it? What is it? Here we go. All right. It's nice to see everyone here this afternoon. We're going to keep going with my segment. It's sort of a running series. We call it the Psychology of Success. It has to do with training your mind and thinking and your attitude to facilitate, success financially, because that's really what we're talking about, this aspect of your life. And what are the beliefs and what are the traps that you can fall into that would take you away from the kinds of attitudes and thought patterns that will actually bring you towards success, right? And how do we avoid pitfalls, and how we build some of these skills and habits to move you that direction in your life. And so today we're going to talk about a concept called human capital, which is a really interesting idea. But first, we'll quickly recap. So first session, we talked about learned helplessness, and you can look that up again, or look up the session, or you can Google it to learn a little more. But the gist here is, there's a way of conditioning yourself to believe that you can't do something. For me, the example I gave was, I'm never going to be in the NBA, right? There are many reasons why I won't, and why I never would have. And so, but the moment I decide that I'm not going to do that, I don't apply myself toward that objective. And so it's a bit of a cause and effect loop that can draw you one direction or another, depending on what you believe about yourself. And so, you want to try and expand that possibility space to be as broad as possible, and that will give you more options and move you toward potential success that you never thought you might be able to do otherwise. And so it's training your thinking to say, maybe I can do this, or at least I'll try. And then hopefully, again, as you have success, you'll be able to believe more about what you're capable of as an individual. And so learned helplessness is the opposite condition, where you just learn that you can't and you can't and you can't because you're going to fail, and then you don't bother trying. So that's a real problem and pattern of behavior you can get into. And so you want to try to change your attitude again and think about things that you can do rather than things that you can't do and don't have control of. And the second session we talked about is thinking about your personal finances as a little business. And so you want to be trying to establish habits and attitudes that line up like a successful business owner would, the way that they would think about running their own, corporation or whatever they're up to, right? And so one of the things we talked about was, trying to dispel certain cognitive biases. And so the example we use is something called mental siloing, where you try to budget your expenses, but you're very rigid about saying, well, this is my cell phone money and this is my transit money, and you don't necessarily treat the picture as a whole when you think about your total ability to spend and your total expenses, and being able to reallocate with fluid movement between categories, and not being so rigid and saying, well, this is my car money and I can't use it for some other end, even though there's something that comes up that would be a better use of that money now, and you could figure out the car purchase later. You're better off to reallocate those funds instead of being so rigid. And so that's one cognitive bias that people can run into. And there's many other examples that you can look up. And then building projections is just simply thinking about planning out, next year, 5, 10-year plans, that sort of thing, the way that a business owner would, and building financial statements, these kinds of documents that people who run businesses always are, monitoring and producing, so that they understand where they are and where they're headed. And so if you treat your personal finances like that, then you're going to be able to make better decisions and have more in-depth analysis about what you might do to improve your financial situation and outcomes and achieve your goals. So that's a recap from the last two sessions. This time we're going to talk about human capital. So what is human capital? I define it broadly, which is we'll start with capital, I guess, which is wealth in the form of money or other assets, right? That's pretty straightforward. A lot of people understand and have heard the word capital, which is basically just your resources financially to be able to do whatever it is you want to do. But human capital is the individual. So as a human being, there's these skills, knowledge, and experience that you've got, or as a collective we have, and what you can produce with those abilities that you might possess, right? And so human capital could be, maybe you're able to build a house or something, right? So you have a certain set of skills and knowledge that then you can turn into wealth, right? Which, I mean, a house is a form of wealth, right? And creating value. And so that's human capital, is the ability, the capacity to produce these things. Whether you do or not, it's the potential to do so. And so I'll show you a little bit of a chart here to help hopefully illustrate that. But this is a sense of where you might analyze an individual's life and say, okay, over time, you have a capacity to earn income. And most people's income is going to look something like this. If you want to retire at 65, you start working maybe when you're a teenager, earning a little bit, then you go to school and get your first job, and then income kind of ramps up over time. And so your human capital is the area underneath that curve. This is all the money that you're going to earn over the course of your entire life, right? And so then you can add that up and come up with an estimation of your human capital. It's a little dehumanizing, ironically, because it's turning people into dollars and cents. So you don't want to necessarily think about it in strict terms that way, but this is the idea: is you've got an ability to earn income in the future, and that's kind of your human capital. It's a way to express it. So why is it an important concept? Well, if you want to think about your financial future, considering your entire working life gives you the ability to make very far-reaching plans and think about, okay, well, what is the future going to hold, and how might I adjust my course of consideration for whatever it is I'm up to improve those outcomes, right? And it's going to help change the way that you think about your financial resources. So, if you look at your entire life as this curve where you've got income that's going to come in the future, and maybe what if you could take some of that money that you're going to earn in the future and use it today? And what if you could, with whatever you did with that money, earn a profit, so that at the end of it all, when you get to the final point, that whole curve has shifted upward, right? You're able to actually have more total resources because you took money from future you, and present you used it then to improve your financial outcomes down the road. That's another way that this way of thinking might change your perspective and your decision making. And then, it also encourages us to think broadly about, okay, how can we crash test my life and figure out what are the things that would blow up this entire plan that I've got, where I'm going to earn this money at a certain age in the future. There are things that might prevent that from coming into your pocket. And so the examples I just throw out here is, what if you get disabled, or what if you have a critical illness, what if you die? And so thinking about your human capital in the future, there are ways that you can actually put insurance policies in place, for example, to make sure that if these catastrophic events were to happen, you still actually get to realize your human capital, in the sense that you've got that risk insured. So there are different ways that you can modify your behavior now when you think about your life from a 10,000 feet, as it were. So how can I invest in my human capital? This is really, I think, the crux of where we want to be focused on in terms of take homes for this segment. So when you think about your human capital, you've got that chart. How can we move that bar, how do we move that line upward, so that there's more area under the curve, which at the end of the day is more money in your pocket, right? More chips on the table. So how do you invest in that? Well, this is a question that I think really is fundamental for a lot of kids growing up when they're going through high school. It's like most people have no clue what they want to do on the other end. You sit down with a guidance counselor and they'll ask you, what are your interests? What are your aptitudes? That kind of thing. And therefore, maybe this is a good job or career path, or this is a good educational course to be taking, whatever, they might recommend. But they don't really, in my experience anyway, no one really talked to me about the idea that I should be considering how to invest in my human capital in these terms, where, okay, depending on which decision I make, I'm going to have these outcomes. And people think about, oh, this job earns more, that job earns less, but why do those jobs earn more or less? And at the end of the day, there are tons of perversions within the capitalist system, but the fundamental ethos is that we're exchanging goods and services to one another. And the idea is that I'll pay you to do something that, for me, it's more valuable to receive the good or service than what it's costing me to pay for it, right? And that's the fundamental ethos of capitalism, is no one's forcing me to, go watch the Kitchener Rangers play the Guelph Storm on Friday, but you know, I go there and I pay an amount of money to receive whatever the benefit is of that experience, and the cost is less than what I'm getting from it. That's the idea there. So how can you improve your human capital? Well, if you can learn to do things well that other people need to have done and are willing to and able to pay for. So you want to think, okay, what are things that I can do that I could improve the technical skills that people really do want and they really can pay for? Do they want it? Can they pay for it? All right. And so some basic examples is really general stuff, but just, can you fix stuff that's broken? Right? That's valuable. It's a valuable skill, right? I mean, I know I phrase that very generally and it's kind of silly to say, but you know, fixing things is very valuable. And if you find that you can do this and solve that problem for another person, they will pay you to do so, right? So if you get good at this stuff, then what you'll find is you've always got work that you could choose to do or not. And you'll have way more options once you get out to the labor market. You know, how to program a computer, how to make beer, whatever. Pick what it is, figure out something that other people really want, get good at that and do it really well. And so this is general high level guidance for anyone who's thinking about, you know, where they should go to school or what sorts of, again, courses of study you might engage in. You want to think about this on the other end. Okay, how are you improving your human capital in as much as you're learning how to do things that other people need to have done and can pay you to do? Obviously, you know, pursuing higher education. I mean, I'm going to put a little red pill on this one for a second. Or is it the blue pill? I don't remember. Whichever one is when you need to have some honest truth delivered to you. But you know, not everyone should be going to college or university. I want to be very clear about that. That's why I put trade schools in there. I think that's a very valuable use of time. A lot of people waste tens of thousands of dollars, more importantly, 4 years of their adult life aimlessly wandering around a university campus studying nothing of importance. And so you know, you can do that if you want to, but just know that there are ways to do university and college that do not improve your human capital at all. So just think carefully about that if you're going to go. You know, if you're at home, take responsibility. You know, I think you'll find that the more responsibility you take in your own personal life to help out around your house, I think you're going to find that things become easier for you in general. People want to have you around, they value your presence, right? I think that you know, not only do you become you'll enter into a more harmonious relationship with people around you, but you can learn things that are going to be useful, you know. And so I recommend anybody can take responsibility around the home, whether it's like, you know, chores, cooking and cleaning, or whatever you can get involved with, you know, depending on how old you are, what your family structure is. So get any employment whatsoever. Just start doing something, even if it sucks, right? I mean, we've all done really stupid or onerous work. You know, I grew up doing construction. It was awful. I hated it. I had to work, you know, 50-hour weeks, 60-hour weeks, and it was just miserable work. And I don't do it now because it just sucked. So so you know, at some point, the idea here with investing in human capital is you can get out of that kind of work, right? But in the meantime, you want to start doing something. It doesn't really matter what it is, but you know, building your work experience and, again, your character, right? Learn how to work hard, because that's going to be useful wherever you go. So the big idea here is become very useful to other people. If you are doing anything that makes you a more useful person to the people around you, that is probably the best way to conceptualize that you're investing in your human capital, becoming useful to other people. And then we can take that graph and shift it up, and that's only going to put you in a better place financially.
Okay, and now thank you, Nate, so much for that presentation. Definitely gave us some food for thought in terms of just thinking about financial planning and how to get us in the proper mindset. Now we're going to have Nathaly go ahead and touch on intro to investing. So Nathaly, I'm going to go ahead and make you the co-host, and then you can go ahead and get started. Okay. Let me see if I can change like this so I don't have to. Yeah, here we go. Oh yeah, you already have it. Okay, you're good to go.
Yeah.
All right.
Okay, perfect, Danny. Well, thank you so much. I'm very excited to be here and being able to educate people and, you know, collaborate with the Knowledge Box. It's a very great initiative. And yeah, today I'll be talking about intro to investing. So it's a very I'll say there's a lot of things that you need to know about finance. So I'll try to keep it as short as possible, and hopefully we can have a second session to dive more into, investing. Investing is definitely one of my favorite topics regarding finance. And yeah, I'm very excited to be here. So what to know as a beginner investor. Today, we're going to be I'll be talking about three different things. First is getting started as early as possible. A lot of people think that they need to know it all before investing, but that's not really the case. You need to have a basic understanding about your, finances and investing. And I believe getting started earlier is the most important thing, because the more time that you spend trying to figure it out, you are losing on the opportunity. And you just have to, kind of get in that mindset and start being disciplined, and things will just be easier. The second will be understanding your investment options. There are many different type of investments out there, but I will be introducing four different type of investments that are the most common ones. And then the third will be knowing the basics of a TFSA and an RRSP, which are investment vehicles accounts. I know it might be confusing because the names of the accounts are savings, but you can actually save and invest within the accounts. Okay, so well, before getting started, I just wanted to introduce myself. Maybe some people will be thinking, who's this girl here who's trying to teach me about investing? Well, my name is Nathaly, and I am the founder of the Financial Talk, which is a community where I educate others, especially women, about personal finance. So the goal is to empower women and also minorities to take ownership of their finances so they can live a better life. I came to Canada as an international student with the hopes to, improve my lifestyle and have a better maybe job, career opportunity. So I came here to study business economics. And just coming to Canada at a young age, I realized that I did not know it all, and especially in the terms of finances, I had to open an account on my own, a checking account, a savings account, and I did not know how to do this. Like, I did not know how a credit card worked, because unfortunately, it's the reality in countries like mine. I'm from Ecuador, South America, and I believe it's kind of the same here in Canada. They do not teach us about personal finance in schools, right? So with that being said, I had to take a student loan to finish my studies, and I was just so overwhelmed about how I'm going to repay this loan. Like, I am working part-time, like, who knows if I'm going to find a job. Like, I was just getting so overwhelmed. And I had a course on personal finance in my like third year of university, and that was life changing. It would just so amaze and like how easy is personal finance. Like, personal finance is 80% about attitude and discipline and 20% about numbers. But for some reason, like, people just think is very complicated, and I feel it's because we do not have that education in high school and when we're younger. So yeah, that's how I got started with the Financial Talk. I just created at the beginning to share my debt and wealth journey, but later on I realized, why don't I also educate people? Like, I'm studying business economics, I'm taking personal finances courses, corporate finance, which is more oriented about like investing. And yeah, I decided to also educate people through the platform, and that's how I have the opportunity to be here today. So yeah, that's a little bit about me. Now let's get started. So first, getting started as early as possible. We have saving versus investing. A lot of people think, I should just be saving or I should just be investing. That's not really the case. You can be doing both, and I'm going to tell you the difference between saving and investing. So saving is just setting your money aside for a goal that you have. Maybe you want to buy a car, right? And you need a down payment. Or maybe you want to create an emergency fund for any emergency that might happen to you. You just want to be sure that you're prepared for it. So that is saving. It's just putting money aside. You can put it in a regular savings account. Others put it on like a high interest savings account, which I'll be explaining later. But it is for the purpose of, I will say, a short-term goal, while investing is more for the long term. When you're thinking about investing, you are thinking, 3 or more years down the road. And the purpose of it is to make your money grow. Maybe you want to, invest for retirement, or maybe you want to invest to get a house down payment. So the purpose of this is to make your money grow for the future. Now, maybe you have heard about inflation. Maybe you heard it on the news, or like someone was talking about it. Just in easy words, inflation is just the increase in price for goods or services, right? So you might have noticed that 20 years ago, if you went grocery shopping with like 20 bucks, you'll get like a handful of food groceries for your home. Now with those same $20, if you go grocery shopping, you might get like 4 or 5 items. So that is the power of inflation. Your money loses power. So if you're just saving and having your money under the mattress, right, you won't be able to afford the same things that you can buy today in the future. And that's why you have to start thinking about investing. So let me show you this graph here. So saving or investing, what should we be doing? Should you be doing? I do both, and I personally encourage people to do both as well. But of course, you need to have a financial plan to know exactly how much money you should be allocating for your savings versus your investing, right? Because ideally, you don't want to have a lot of money saved for the same purpose that your money will lose power, purchasing power, right? So with inflation, the government usually tries to keep inflation between 1 to 3%. In this example, I'm using a 2% inflation rate, okay? And we're gonna have 3 different scenarios. So if you were to deposit 10,000 in 10 years, let's say that your regular savings account pays 1%. This is a very, very, I'll say unrealistic example because savings accounts usually pay like 0.50% or 0.10%. So this is for you to have an idea on why you have to start considering investing.
Robbery.
Yeah, definitely. So if you were to deposit 10,000 in 30 years, your money will be actually worth 7,441, right? Basically, in that transaction, or you putting your money aside, you lost like 2,600. It's a lot of money that you could have used, right? Now, if you were to put it on a ISA, which is a high interest savings account, there's many banks that offer them. Usually there are online banks like EQ Bank or Modi Financial. They usually offer a way higher interest rate. So I know right now it's like 1.25%, but when I was working on these posts, it was about 2%. So with this type of account, you are keeping up with inflation. You are not gaining, but you're not losing, right? So your money's worth stays the same. Now, if we go to the third scenario with investing at an 8% rate, and the reason why I use 8% is because that's usually the average that the stock market returns. Right, so with an 8% rate, minus obviously the 2% inflation, your money will grow to 55,553. So that is the power of investing. And why does this happen? So like, why does your savings just not grow at the same speed as investing? This is because of our best friend, compounding interest, or also our worst nightmare, because credit cards, when you get a credit card, it says 29% interest, let's say. That's compounded interest. So if you don't pay your credit card on time, well, you're going to have interest on the interest, and it's going to be a huge bill. But when it comes to investing, compounded interest is actually your best friend, because it will help your money grow, and then the interest that you make on that money, it will grow, and it will be like a snowball effect, right? So when you invest, you can see is with compounded interest is an exponential growth, right? While if you just save your money, it's just a flat growth. Okay, so that's why just going back to the first slide, you need to start earlier, right? The more time you take on trying to decide, should I invest or not, you're losing time, and therefore you are losing the power of compounded interest. So now that we know this, you're like, okay, I'm ready to start investing, but what do I invest in? Like, I have no clue, right? So there, as I said, there are different type of investments out there. I'm just going to go over these 4, which I believe are the most advertised and that people are familiar with. And they are great ways to get started into investing. So first, we have stocks. So stocks, very easy. It's the ownership of a company. If you buy stock, you buy them as shares of a company, right? You buy one stock, that's one share of a company. You're pretty much a business owner. You don't need to open up your own, I don't know, restaurant or your own beauty shop or anything. Like, you literally are a business owner through stocks, and you get voting rights. You get to make decisions for that company. Even if you buy one share, you are an owner, but you will have like 0.00001% ownership, but you're still an owner, right? With the stocks, what people try to do is they will like the stock to grow, so that way they gain money, and that's what they call the capital gains, right? Now, stocks are risky, right? You have to know about the company, you have to know their financial statements, see if they're going to perform well or no. But if you're just getting started, I believe the best and easiest way to get started, or at least when I started, is I decided to go for stocks of companies that I was familiar with, right? I have this phone here. It's an Apple phone, right? I use my iPhone every day. I have a MacBook. I have an iPad. I have AirPods. So I believe in the company. I keep consuming Apple products. So there must be something that the company is doing well. So that's why I decided to buy Apple stock, right? You might drink Starbucks every day. Starbucks has stocks as well. You might, I don't know, you might not have an iPhone, but you might have a Samsung or a Microsoft computer, or you go to Walmart and you're there grocery shopping, right? So all those companies, as long as they're public, you can buy stocks. Okay, then you have GICs. These ones are more safe, but they're on the safer side. But because of that, their return is not that big. Usually people, so usually they promise to give you your money back. So the way it works is when you buy a GIC, you're pretty much just buying a note that is guaranteeing that you will receive certain type of income and certain period of time. So if you buy a GIC that is 1% for 1 year, then you put $1,000, right? And then you'll get $10 in interest in 1 year. So that's how it works. There are different type of GICs out there, and you can also invest through that instrument. I have not purchased GICs because I consider myself a little bit more I'll say I want more risk, right? But that's why maybe on the next session, you will learn about, your risk profile, how to diversify your portfolio like investments, because it's not that you have to pick one of this and that's it, right? You can have different a combination of all of these type of investments, right? Then for mutual funds is very popular as well, advertised a lot by the banks. So mutual funds is just a pool of money that is collected by different investors. So let's say Danny here, he puts up some money, I put some money, and then the company will just decide, depending on the type of mutual funds, you know, what are they going to purchase. So they can buy stocks or they can buy bonds. And then the company managing that pool of funds, in this case, the mutual funds, they will charge you a management fee for that, right? So they might say, okay, we'll charge you 2%. That's usually the average. So that means that they will take 2% of your money, and then you'll receive the rest as gains. Now, the last one is exchange traded funds, also known as ETFs. This is actually how I got started into investing. This one it has lower risk than stocks. And they are very flexible in the sense that you can buy them just like you buy stocks. For mutual funds, you need to go through a bank or through like a company to purchase them. But for ETFs, you can just open an investment account and like buy them on your own, pretty much. So this is just a pool of different investments. So there can be an ETF that tracks, I don't know, all the technology companies in the US, right? So you will have a product, in this case, the ETF, that will have, you know, shares of, I don't know, Apple, Samsung, Microsoft. So all technology companies in just one product, and you will have exposure to that. So because of that feature is very diversified, right? It has a lot of different, let's say in this case, stocks, right? It's less risky than just owning one company, right? So one company, let's say Apple versus 100 technology companies, you are more diversified if you own ownership, if you have like ownership of 100 companies instead. So hopefully that, you know, it's a little bit clear. I tried to make it as, you know, as easy as possible. And the way that I like to compare stocks and ETFs is just think of a stock as a fruit, is an apple, or I don't know, watermelon, your favorite fruit. And ETF is just a fruit salad, right? You get to try all the different fruits in that fruit bowl. So yeah. Perfect. And third, the basics of a TFSA and RRSP account. So as I mentioned, TFSA and RRSP, they are not only savings account. This is why people get confused, because TFSA stands for tax-free savings account and RRSP stands for registered retirement savings plan. But actually, they should be called investment accounts as well. So on a tax-free savings account, you can earn income from your investments tax-free. So basically, you don't have to pay Uncle Sam if you make any withdrawals, right? Like they will be tax-free. Now with an RRSP, you can withdraw, but you will have to pay taxes. So this was created more for Canadians to save for retirement. But it is tax deductible. So I'll get into that later on. So let me go quickly over a tax-free savings account. You know, you can open this if you're 18 years old, you live in Canada, you have a SIN number, you're good to open this account. Pretty much, you will get a limit. So if you were 18 years old, let's say, or more when it was like 2009, and you have never ever had an account, right now your limit will be 75,500 because that's a limit for 2021. So every year the government increases the limit, right? As you can see, this year was 6,000, last year was 6,000 as well. So if you have never contributed, it just starts accumulating. So with the limit, it pretty much means how much money can you put in that account, right? So if you open a TFSA and you have never contributed, then you know your limit, you can deposit that and you can go ahead and start investing, right? Now, let's say that you invest, you make some money, good for you. Now you want to withdraw that money for school or to buy a car or whatever is your plan, right? You can withdraw it and you don't have to pay taxes. Okay, so that is the purpose of this account. If you do not have a TFSA and you're more than 18 years old, I will advise you to log into your Canada Revenue Agency website, the website, or you can also check your previous tax slips, and you can find the limit there. Okay, so with the TFSA, as I said, it can be a savings account. A lot of banks offer them, but they might only not allow you to invest, but they might pay you some interest, or they might tell you, you can only invest in GICs. But there's also self-directed tax-free savings account where you can invest on your own. So you can pick, let's say I want to buy the stock, so you can select the stock that you want or the ETF that you want, and then you have the manage where it's invested on your behalf, and usually it will be invested on mutual funds, or it might be some kind of robo advisor, right? Where it will be invested in, let's say, ETFs. And these are pretty much all the type of investments that are allowed on a TFSA. These are the ones that we went over. And hey, you don't need to have just one. You can have as many as you like. Like I have one TFSA for only ETFs, and then I have one TFSA for only stocks. And that's just how my brain works. Like I just need to categorize things. You just have to remember that you just have one limit. So if your limit is 75,000, is 75,000 for all of your accounts, not per account. So that's very important. Okay, now an RRSP is more for retirement, is as the name says, retirement savings plan, and it can be for you, or they also have the spousal RRSP, right? Now with the RRSP, the limit is a little bit different. It can be either 18% of your earned income, or it can be just the limit that they have for the year, which right now in 2021 is 27,830. Whichever is lower is what you can contribute to the account. Now, the difference with the tax-free savings account is that if you want to withdraw money from your RRSP, you'll have to pay tax. It is not tax deductible. You have to pay tax according to your tax bracket. There are some exceptions. If you want to purchase a home, there's a home buyer's plan, or if you want to go back to studying, there is I don't remember the name, but it's like learning plan where you can withdraw the funds, but you have to deposit them back. However, this type of account is tax deferral, which means that if let's say you contributed 10,000 to the account and you make, let's say 60,000, then you can say, okay, my income is 50,000. So 60 minus 10, it will be 50,000. So it is tax deductible. That's why when it comes RRSP season, that's how they call it. It's just people trying to put money on their RRSP so they can make their income lower due to the fact that this account is tax deductible. And then the other advantage is tax deferral. So any money that you deposit there, it remains on the plan. The goal is that when you are old and you're not making that much money, when you want to withdraw the funds, you will be on a lower tax bracket. So you'll have to pay less tax as if you were to withdraw it right now, where you're like maybe, working and things like that and making a good income, that you will be taxed way more. Okay, and the same thing, the type of RRSP, just like the TFSA, there might be some that is only savings, self-directed, managed RRSP. The type of investments will be the same as the TFSA, and same thing. You can have as many RRSPs as you want, but you have to be aware that you only have one limit. You can withdraw if you plan to buy a house or pursue further education. Okay. So that's pretty much the accounts. And now you might be wondering, okay, this is great. Like I learned so much. Now I am just ready to open an account. So you can do that by going through a bank, like the big banks. You can ask right now your bank where you have your checking or like a savings account and see if they offer any type of like self-directed, if you want to have control of it, or if you want to do a managed account, or you can go through a broker. And we have the examples here, right? There are other brokers. I'm sure a Google search will make things easier. You'll be able to compare, because you also have to take into consideration any type of fees that these institutions might charge. Okay, perfect. So if you want further information about investing in personal finance, as I said, I build the Financial Talk community to empower other women and minorities to take care of their finances and live their best life. So you can find more in my social media, the Financial Talk. Any questions, you can shoot me an email, and I'll have a website coming soon.
Okay. Wow, wow. That was incredible, Nathaly. Thank you so much for that presentation. You really did give us like a nice foundation and just the fundamentals of investing, and even some of the things I've been learning myself personally. It was right in line with what you were educating us on. So thank you. We did have a couple of questions, so I just wanted to relay those. One question was about, I guess, just like, well, you already mentioned you gave yourself as a resource, but that was one of the questions. What books, resources would you suggest for like a little bit of self-study in terms of getting into investing? Like any magazines or anything that you would recommend?
Yeah, for sure. So honestly, the Canada, the government of Canada website has a ton of information about personal finance. They even have a slides, they have like a workbook, and I do not know why they do not advertise that enough. But that's definitely, you know, a resource that you can search up. And now in terms of like maybe understanding the difference between mutual funds and ETFs, there's a great book by a Canadian author, Larry Bates. It's called Beat the Bank. So that is a very short book, around like 250 pages. It was eye-opening. I usually tell clients as well, that are maybe, you know, trying to switch from mutual funds to ETF, or are scared to do it. This book just gives you a great overview on like why it's best for you to do that.
Wow. Okay. And I'm definitely gonna share those links with any of the attendees or anybody who comes across this session. So thank you for that information. And then one more question was in line with what you just were mentioning, because in the beginning of your presentation, you were talking about your preferences in terms of your investing strategy. And I guess you were like more safe or less safe, more risk involved. And that, I think that touched on what somebody was asking about confidence and fear. So what was maybe, what can you, I guess, maybe give advice you would give someone for turning that corner in terms of taking bigger risk, and what is maybe the vision that kind of give people to take those chances if they need to?
For sure. I mean, you know, doing something new is very scary, right? But I feel everything in baby steps, right? If you want to get started investing, but you don't want to put like your life savings into investing, you don't have to do that. Like with technology, investing have become so much more accessible and easier to get started than before. Like before, to invest, you needed to be rich, or like you needed to have certain amount of equity. Now you can get started with like 25 bucks, 50 bucks, right? It will be compared like you going out to a restaurant and just putting that aside to invest. So I think that's the best way to get started. Start small, right? Maybe instead of going out on a weekend, just put the money aside and say, okay, let's give investing a try. And there are also, if you don't want, you know, like I was a student, right? So $25 for me made a huge difference, like when I was a student, right? There are also a lot of platforms available when you can practice with fake money. And that will definitely help you build the confidence and also discipline to get started.
There you go. You heard it. You heard it from
Yeah.
Nathaly. Great advice and insight right there. So yeah, we just want to thank you once again, Nathaly, for joining us and imparting your wisdom on everyone who got a chance to check this session out, whether you're checking out on YouTube or you're here live. And yeah, look out for the next session. It should be coming soon. Probably Intro to Investing Part 2. We'll send that information out to you. And we just want to thank you once again for joining us. And we're going to sign out. Have a good afternoon.
Yeah. Well, thanks for having me, Danny. Take care.